Hello. In this video, we will discuss stock market bubbles, specifically whether the US stock market, which has been soaring since October 2023, is in a bubble, expensive or very expensive. The S&P 500 index is flying, and if you look at the pricing of leading indices and how much investors are willing to pay for an average profit on a dollar, it is the highest in the US. I'm Marcel Dibus. Welcome to Marcel's Markets. Los geht's! Part of the high pricing is explained. The US market is indeed unique in many ways. The great companies are almost all from here, and the US economy is the healthiest of the big ones. They have the most money, and they favor their own market. If you look at this PE ratio over the longer term, you can see that we are now in the higher range, confirmed by the chart borrowed from JP Morgan. The solution here could be for companies' profits to rise in the future or for the share price to fall. After the red line, you can see the analyst consensus for future earnings growth. If that comes in and the rate just moves sideways for a year, then that makes the market average priced. So on that basis, it's not a bubble, but it's expensive. Suppose you look at the Shiller PE ratio with the 10-year average data plus inflation. In that case, it shows exceptionally high pricing, which is not what the 2021 peak was, but it is close. Jeremy Grantham, a veteran investor who is basically pessimistic and previously predicted a fall like in the 1929 crisis, says that if this indicator is above 34, which it is now, then there is no way to expect a sustainable bull market, meaning that it is going to fall big over time. What a significant fall is relative, of course. So we've been sitting in a prolonged upward wave for some time now, and we've been up 1,100 points. It is not a big deal if we fall back a third or half of that. It is a mere 10% crash, what the media will call a significant fall. It is an entirely natural correction. It keeps the big picture the same. Returning to Grantham, who reinforces his pessimism by saying that if the labor market is saturated, as it is in the US, the stock market will not fly for long, at least not in the experience of the last few decades. Let us examine the earlier used Shiller indicator, considering the risk-free return on government bonds. In that case, we again conclude that the US market is expensive, and when the pendulum, or the indicator, swung upwards here, the exchange rate swung downwards in the past. Of course, these indicators indicate optimism is overdrawn, but these conditions can easily persist for many months. The timing is the challenge. Unfortunately, hitting the highs and lows is still more of a matter of luck than knowledge. In the past, when the US index was trading at similar rates, those who bought were pocketing a 5-year return of around 3 to 5%, at least according to JP Morgan. This demonstrates that the more you pay for a dollar profit, the more your future return will decline. The market tends to overshoot things on the downside and the upside. By the way, this allows chasing individual stocks. So enough of the gloating, because it's not that bad, or more accurately, it's complex because stocks didn't rise uniformly. Mostly, the well-known artificial intelligence tech stocks, called Magnificent Seven, took off. If you know what Nvidia is but don't know who Charles Bronson is, you should watch this movie, not Nvidia's chart. So, the weight of these tech companies has increased in the index. In fact, the weight of the top 10 stocks has never been this high, and only a dozen highly priced tech stocks have pulled up the price of the S&P 500. The rest are below average right now. In fact, several sectors have lagged, such as energy and mining. More specifically, you can see here, for example, oil companies and say lithium miners are like that. Microsoft, Meta, and their peers are soaring, but it's not just the stock price rising. It's the profits. The top 10 companies in the S&P 500 index take 25% of the total profit of the whole index. So right now, the market loves good companies that are growing profits, but there is a good chance that some are overloved, so that's human nature. But not everyone gets love. Tesla and Apple, for example, are in the red this year, even though they are also in the Super 7. So again, it's not a bubble. There's a basis for rejoicing here, but now the stock prices have been pushed to such a high level that anyone who buys a share in such a good company now, say Nvidia, is unlikely to get a dizzying return in the next few years, say 5 years. That's because he is already paying out the expected high profits in the future in advance. One classic example is Microsoft, which was almost as cool in the early 2000s as Nvidia is now. It was highly priced, and the investors were right. It was a good company Microsoft became, and profits increased in the following years. Still, the stock price stayed the same for about 10 years because the stock price was so far ahead. Now, Nvidia is the Microsoft of the 2000s. Okay, but what can break the rose-colored glasses of investors? The first cracks may have already appeared on the lens anyway. Here, the stickier than expected US inflation is already beating expectations for the third month. It is increasingly likely that there will be only 2 interest rate cuts instead of the 3 previously expected. Some bond traders are already preparing for a period of bond yields without the 5% rate cut, which alone is enough to bring a correction here after a 6-month run. As for cutting rates or not cutting rates, former Treasury Secretary Larry Summers, going even further, is already talking about more rate hikes. There are these roles that these intelligent people are putting on themselves. Larry Summers, for example, has been talking about higher inflation for a long time, which has worked for him. Meanwhile, Jeremy Grantham has been waiting for a crash for years. It's worth listening to the different thoughts, but I'll never base investment decisions on such things, that's for sure. Apart from the interest rate cut, there are obviously all sorts of war tensions, the invasion of Taiwan, and natural disasters that could take the joy out of stock markets. But speculating about these is even more of a guess than guessing about future inflation. So what do we do when the US market looks expensive? Well, I won't change anything. I don't touch my US portfolio and I don't realize a profit. It's been bought for many years and there's no reason to rush. If you are just starting out in the business, America is still an indispensable part of the portfolio. At most, the proportions shift slightly, but you can build everything from the same Lego elements. That's assuming you're considering a long-term portfolio and operating on a steady savings basis. Over the last 10 or so years, the US large-cap equity portfolio has beaten all others in terms of returns, but it's not a foregone conclusion that it will stay that way. In fact, in the past, it's been about evenly split between when the US and when emerging markets have delivered the higher returns. See this chart, given that the US is, on average, now at relatively high prices. It would not be surprising if the order were reversed again and emerging markets performed better. The easiest way to ride this is with an emerging market ETF. In case you're scared of China, there's also a version that doesn't include China. That's all I could fit into this video. Please like, share, and subscribe if you liked this video and if it was helpful. Of course, I look forward to your comments. I'm Marcel Debus. Thanks for your attention. Bye.